Hi, Meenakshi. Am I audible? Joy, am I audible?
Yes, you are.
I think there was a technical glitch.
Yeah, because it was showing like a server crashed or something
Yeah.
because of high numbers.
So I think the attendees are also going up. So we'll wait for about 2-3 minutes and then we'll start. Till then, you
Okay.
can share your screen and check.
Sorry, I do not. I think Meenakshi will do that. Meenakshi, can you hear us?
Meenakshi, if you're talking, you're on mute.
I think she is reconnecting. Ah, okay.
I'm Meenakshi. Can we have the presentation on the screen, please? Great. Can we move ahead, please? Is my voice clear, Meenakshi?
Yes. So Jai, we can hear you. We can see the screen as well.
All right. Meenakshi, please move ahead. Let's see the agenda page. All the 4 points. All right. So today we are going to discuss primarily 4 things. Number 1, we are going to figure out whether the tax efficiency, how does it matter in terms of building wealth? Number 1. Number 2, we are also trying to figure out how do we leverage few tax advantage legal accounts. Okay. And what's the importance to diversify your portfolio and allocate it strategically? And finally, what makes it to become a great investor? All right, let's move ahead. Number 1, significance of tax efficiency. So let me ask you one quick question. So when it comes to wealth accumulation, so everybody is looking to create wealth, right? People, obviously, there is some income which is happening. From that income, we pay our taxes, and whatever is left behind, we spend some portion of the money. The remaining portion of the money is actually saved. All right. So while we are saving that money or we are investing that money, there is also certain taxes which eat into that. Nobody really enjoys that. So there are great ways of saving that tax which is paid when you're doing your investments. All right. So efficiency in the way we pay our taxes while we do our investments is crucial when we build our overall investments. Let me ask you one quick polling question. Can we have the polling question number 9, please, on the screen? Question number 9. Polling question number 9 on the screen, please. On for about 30 seconds. Everybody, may I request you to look at polling question number 9, which is on the screen right now for 30 seconds, and then let's see the result. The question is, if you have invested 10,000 in the market, earning 10% every year for a period of 20 years, what is the final amount? So there is no right and wrong. I got to show something, that's why. Can we have the result, please, on the screen? All right, so 5% have selected A, 75% have selected 1,20,000, 11% have selected 74,002. The right answer is actually 74,002. So 10,000 invested in the market, earning 10% every year, is actually going to yield 74,002. All right. Can we have 10 more seconds on this? And the last 10 seconds. Okay. Now, I'm going to display one more question over here. Question number 10, please, on the polling question number 10. Polling question number 10, please. All of you, polling question number 10. Can we have everybody respond? So the question is, 74,002 is what you made if you have invested 10,000 rupees in the market for a period of 20 years, earning 10%. However, if you are paying a tax of 30%, what is the final amount? So you could notice, I think a huge number of people have already selected the answers. I will just wait for 10 more seconds before moving ahead. Last 5 seconds. All right, let's see the answers. So it is actually 41,405 and 62% of you have got it correct. So the point is, when you are paying 30% tax on your income or on your earnings, the drop in the overall wealth is significantly higher. It drops by 50%. So that is the importance. That is the importance of saving taxes, because even if you are saving 10% of your tax outgo, your final wealth accumulation could be significantly higher. Let's look at what is in store. Meenakshi, can we have the next slide, please? So tax efficiency primarily helps in maximizing net returns. So everybody knows that. So if you're saving on tax, you're building up on your final income. Next slide, please. So the entire slide, please, quickly. All right. So broadly, if you are looking to save tax, there is a section called 80C, which really gives away a lot of benefits for people who are looking to invest money in the market. All right. So invest money in the market. And there are a lot of tax deductions available. So can we have the next slide, please? The entire section, please. Okay. So if you look at this slide, I'm sure this would be available to you post this presentation. So there are several ways you can save tax. The most important ways are like the ULIPs or the ELSs or the Public Provident Fund. These are mostly the sections under 80C. So whenever you're making your investments, ensure that you definitely have some investments under the section 80C. Under this section, there are a lot of deductions which are available. So when you are actually investing in that particular avenue of investment, the amount that you invest is deducted from your taxable income. So that means you do not pay tax on it at the time of income, and you get some kind of assured or a significantly higher return as well. So there are several of them, like life insurance policies, mutual funds, tax-saver fixed deposits, national savings certificates. So there is a plethora of investment avenues which are definitely available to all of us. All right, can we move to the next section, please? Next slide. Tax loss harvesting. Tax loss harvesting. So how many of us know actually what this tax loss harvesting is? Can we have everybody on the mute, please, even the organizers? What is this tax loss harvesting? How many of us know this? So tax loss harvesting is very, very interesting. What it says is that suppose you have two investments. On one, you have made a profit of 100 rupees, and on the other, you have made a loss of 100 rupees. Okay? So if you do not take any action at the end of the year, on the profit of 100 rupees, you will end up paying some kind of tax. However, but the point is, when you're booking the gain of 100 rupees from that market on that position, you also book the loss of 100 rupees on the other investments that you have made. So on one, you have made 100 rupees profit, on the other, you have made 100 rupees loss. So when you're booking your amount, you book the profit and you book the loss together in the same financial year. So the profit of one gets neutralized because of the loss of the other. Okay? In that process, you do not pay any tax in that year. Can we have the slide, please? The next slide. So always keep in mind, when you are making your investments and there is some profit in some place, look for some commensurate loss in some other place. Maybe commensurate, maybe little less, maybe little more, doesn't matter. Okay? But definitely you can book certain losses, and that will have significant impact on your overall tax go for that year. Okay? So on equities, incidentally, it is 15% tax on your short terms and 10% on your long terms. All right, let's move ahead. Assets. So there are primarily two kinds of assets, right? Debt and equity. And both these assets actually move in different ways. Debt possibly gives a lower return. Equity significantly gives a higher return. When we talk about investments, most of us run behind equity. But there is one small thing that we many a times actually overlook, and that is the volatility of returns. Okay? So what is volatility of returns? Can we have the next slide, please? Volatility of returns is the variation of return over a long period average. For example, suppose there is a long period return of 10% for a particular asset class, let's say 10%, but there would be years it could deliver more than 10, and then there would be years it could deliver less than 10. How much deviation it makes from 10 is the volatility. There could be years it delivers 12, there could be years it delivers 8. That means the volatility of return is 2% because the deviation from the mean. So the volatility of the equity market returns in India is approximately 20.5%. Okay, and the volatility of returns of the debt is 3.5%. So now can you make out the difference? So while equity delivers a significantly higher return, so the debt is delivering 7% return, equity delivers 14% return. But that 14% return comes with a volatility of 20.5%. That means 20.5 over and above 14. So there would be years it could deliver 34, and then there would be years it could also deliver 6. So that is the variation of return that happens because of equity. On the other hand, debt has got a very, very contained volatility. So on a return of 7%, sometimes it's 10.5, sometimes it's 3.5. It's never as much as a negative return. So always remember in mind, so when you're building your portfolio on one hand, while you're looking at your tax outgo, tax efficient investments, primarily there are two ways to save tax. So when you're making your investments, when you're placing your money, look for those tax advantage or tax leveraged investment choices. And secondly, look at some kind of tax harvesting. So these are the two definite great ways of saving tax when you're making your investments. And secondly, while you're creating your portfolio, look at both equity and debt holistically. Debt, while it delivers a lower return, doesn't mean it is a poorer investment choice. It is also a very significant, powerful investment choice because the volatility of returns is significantly lower. All right. So now I'm going to request for one more polling question to come up. Can I have 1 second? The polling question number 1, please. Can we have the polling question number 1 on the screen, please, for 30 seconds? What is the primary goal of tax efficiency? All of you, please. What is the primary goal? What are we trying to achieve? What is the primary goal of tax efficiency? Is it to maximize gross returns? Is it to maximize net returns? Is it to minimize investments, or is it to minimize risk? Last 10 seconds, please. Can we have everybody respond to this question? All of you. Last 5 seconds. Okay. Let's publish the results. So we have 67% selecting maximizing net returns, which is definitely the right answer. Okay. Can we have one more back-to-back question? Since we have just covered that point, can we have polling question number 2, please? So we just went through it, just refreshing our mind. So which section under income tax is associated with tax saving investments? Is it 80C? Is it 24B? Is it 80D? Or all of the above? Come on, we just did that. Always remember, it is which one? Come on, last 30 seconds. We have everybody respond to this question, please. All right, so maybe slightly different. So it is actually C, which is 80C. So 80C is the section which carries all these opportunities to save tax as a tax saving instrument. All right, let's move ahead. Can we have the next slide, please? Diversification. So we looked at two asset classes, equity and debt. So there is a very powerful, investment principle, and that is the principle of diversification. So when you invest into one asset type, like for example, Indian equity is hitting all-time highs. Everybody would be loving to invest into equity, but is it still the most compelling investment choice? Maybe it's a debatable point, because along with this superior returns comes very high levels of volatility. So always keep in mind, as you prepare yourself to become a great investor, there is a power in this investment principle of diversification. Always look at diversification when you make your investment choices. Can we have one more polling question? Okay. Can we have the polling question number 5? Come on, please. Polling question number 5. Okay. So what is the tax rate on long-term capital gains, which is above 1 lakh? Is it 5%? Is it 10%? Is it 15%? Or is it 20%? We just covered that. Just refreshing your mind. All of you, please, come on. We have a large population in this webinar today. May I request everybody to respond? Last 10 seconds. Okay, can somebody? Yeah, hi, Meenakshi, can we have the screen, please? Somebody shut this door. Hi. Can we have the PPT on the screen, please?
You can see the screen now.
Yes. Yes. The slide, please. All right. So let's move ahead. I think there is some technical band issue which is happening. Nevertheless, can we have the next slide, please? All right. So primarily, if you are looking to become a great investor, there are a few things that needs to be thought through. Okay. Number one is education. What? Because it is a subject that needs to be learned. It doesn't come naturally. It's not like swimming. Like the way we get into the water, we will get drowned. You have to learn swimming. You have to learn cycling. Similarly, we need to educate ourselves to become a great investor. Can we have the next one, please? Practical experience. The more amount of time you spend with people who have gone through this cycles of investments, so reading about great investors, learning from them, spending time with them, looking at mock portfolios definitely is a great way of building your acumen. Third one, please. Mindset. There is a mindset, but definitely which is called the anchoring bias. Okay. So let me give you an example. Investment, making money through investment is a game of probability. Okay. Suppose you have a stone in hand, and then there are 2 mango trees in front of you. One mango tree which has got 2 mangoes, and the other one has got, let's say, 50 mangoes. You would throw the stone on the mango tree which has definitely got 50 mangoes. Why? Because the probability of hitting that one mango by the stone that you have is definitely much higher. Okay? Can we have everybody on the mute, please? All right. So investment is similarly like a game of probability. However, we as human beings have certain bias. And what is the most important bias which is actually pulling us behind is our mindset around anchoring bias. Our mind gets anchored to the experience that we have gone through in the past. So we need to improve and overcome certain mindsets and biases. The fourth one. Meenakshi, fourth one, please. Risk management. So while you're investing in the market, there is volatility, there will be hazard kind of other risks. So identify. So market is not about how to get more return. Market is all about how to identify the risk. If you have identified the risk, you would be able to generate the return. So this is the beauty of the market. Generally, we as investors run behind return. But return happens because there is existence of risk. Abhi bazaar mein zyada returns kyun aa rahi hai? Obviously, there is certain additional risk which is there, and the return is trying to compensate that risk. Always remember, the market is delivering higher return because the market is compensating you for some additional risk somewhere. Try to identify the risk. You would know whether the return will continue. Let's move ahead. All right, let's look at a story. Okay, let's look at a story. Next 10 minutes, we're going to spend time on a story. Let's go back 3.5 years. COVID times, markets crashed by 40%. Everybody is locked up in their homes. However, if you look at the screen over here, the Sensex fell by 40%, and then it took a U-turn, and the rest is actually history. Market almost like doubled or tripled in this last 2-3 years and so on. So what really has gone correct in favor of equity investors in India? Let's move ahead. Look at this story. During COVID times, the shops were shut. People were not stepping out of their homes. Many of us were not required to go to offices. There were less activity everywhere. People were losing jobs. It was a time of gloom and doom. Correct? Let's move ahead. People were not spending money, right? So there was drop in consumer spending. And because people were not spending money, consumers were not spending money, the factories were not producing enough. So there was an economic slowdown. So it was a perfect case of gloom and doom. All right. However, the markets took a U-turn. Today, we are going to learn what is that which made those great investors who definitely made big money during this period, the last 3.5 years. Let's go ahead.
I think there's some issue with the screen share. I'll just share it again. One moment, please. Hope you can see my screen.
Yes, I can definitely see your screen. Can somebody confirm whether the screen is visible?
Visible. Yeah, it's visible.
Okay. Can we have the next?
It's visible on the attendee session view also. Don't worry.
Okay. Meenakshi, let's move ahead. Meenakshi, let's move ahead. Meenakshi, are you there? Move ahead, please. Yeah. So, one slide back, please. One slide back. Okay, this is where it should be. Okay, hold on here. So, during this period, what really happened? The first and foremost thing so there were two people who were responsible to improve the conditions, right? Because of the gloom and doom. One was government, second was RBI. So both of them were taking actions to improve the condition. Amongst the many things that RBI did, one thing was they dropped interest rates. Okay. Now, what is the significance of that? So as interest rates came down, there was one kind of people who definitely was extremely unhappy. This is the person on the bottom left-hand corner. Can somebody write in the chat box, who do you think this person is, was extremely unhappy? He was somebody like us. Who do you think this person is, who was extremely unhappy? Anyone? Please write in the chat box. Common man. Anyone else? Who is this common man? Thank you, Sandhya. Which common man? So this were the who? Fixed depositors. Absolutely. So this were the set of people who keep the money in the bank. Because if you are a depositor and as the interest rates come down, you definitely would be unhappy. Right? So let's move ahead. Meenakshi. So as we move ahead, okay, sorry. So as you are a depositor, you are unhappy. So what would you do? You would obviously look for certain alternatives. You cannot be unhappy for long, right? So you would look for an alternative. Amongst the alternatives that people generally look at during low interest rates, the first one is bonds. People shift to something which is pretty similar. So they looked at bonds. People started investing in bonds. Let's move ahead. As you invested in bonds, let's move ahead, Meenakshi. As you move ahead, move into bonds, the prices of bonds will go up. Like a normal law of demand and supply, whenever you invest into something, prices go up. So when prices of bonds went up, the yields came down because more and more money moved in there. Bonds become unattractive because the yields started to come down. So as the yields started to come down, Meenakshi, ahead, please. The depositor who shifted to the bond market, no, ma'am, let's move back. Let's skip to that. Yes, let's stay here. So as the depositor who moved from the bank to the bond market, the prices went up, yields came down. So once again, he becomes unhappy. The reason he becomes unhappy this time is because initially he was unhappy because the interest rates on his fixed deposits came down. Then he moved into bonds, so the yields on his bonds comes down. And again, he's unhappy because of this action of the market. He starts to look for an alternative again. Next slide, please. This time, he looks at something little more riskier. So equity is one of the options because we move from bank to bonds and then from bonds to equity. Once you start investing into equity, let's move ahead, Meenakshi. The prices of equity starts to go up. So this is what really happened when we saw that big U-turn in the equity market somewhere in March, April of 2020 itself. Because interest rates were brought down by RBI. As interest rates moved down, people become unhappy with the bank and they shifted out. And these people, look at this person on the screen here, become extremely happy because he has made the right choice. Okay, let's move ahead. Actually, let's move ahead. So, as people make money, obviously you become happy, right? If you are happy, what do you do? Please write in the chat box. What do you do when you are happy? What do you do when you are happy? You spend. Absolutely. Meenakshi, next slide, please. You start to spend money. So when you start to spend money, absolutely. When you start to spend money, you go out, you eat, you party, you spend money. So and that is how the economy revives. Because next slide, please, Meenakshi. No, sorry, go back. Okay. So this is the famous way how the markets turned around. Okay. So we were in the worst of the COVID times. Interest rates were low, people were losing jobs, people were not getting money, their bonuses, their salaries, and there was gloom and doom all around. But despite all of that, there was this massive turn in the equity market which happened, and that primarily happened because of the drop in interest rates. And as interest rates move lower, people who keep money in a bank move out from a bank and move into alternative assets. The first alternative is a bond. The next alternative is equity. Once you start investing into equity, prices starts to go up. And as prices goes up, there is money to be made, there is capital gain, and that makes the investors happy. And when you are happy, you actually go out and spend money. And when you start to spend money, as we start to spend money, the economy starts to revive once again because the economic activity comes back. All right. So this is the second thing that I wanted to talk to you about. The first is that on tax efficient wealth accumulation. So there are two ways to save tax and grow your wealth. Number one, you have to invest into tax leveraged investment choices. That is one. Second, whenever there is some capital gain somewhere, do not always just jump in and start to pay taxes on that. Okay? You definitely can find some places where there is some kind of capital loss. All right. So try and book those losses on those investments as well and adjust them against your capital gains. In this way, it is called tax loss harvesting. Tax loss harvesting. This is a great way to save taxes. The third thing you remember, even if you're paying a 10% or a 20% additional tax outgo, your final wealth accumulation would be significantly lower. Please work on your tax outgoes. There is a way to build it. So how do I prepare ourselves? There is a way to educate ourselves. There is a way to build our mindset. There is a way to train ourselves to looking at others and making these smart choices. How should we go about? There are various ways to go about. The most important way is to create a very well diversified portfolio. Do not put everything into a winning asset. A winning asset is an asset which is delivering a superior return. Superior return is fantastic, but higher return means that that asset is delivering a higher return because of existence of higher amount of risk. Try to identify the risk in the market. Life is going to be great thereafter. Not to chase returns, try to identify risk. If we have identified the risk, definitely the returns for the market is going to be much superior. And finally, and most importantly, look at where the interest rates are headed. If interest rates are moving southwards, remember, the people who keep money in a bank would get worried over a period of time because their deposits in a bank will not be earning as high or as much as before. And if the people in the bank gets disappointed or they are worried, they obviously will look for an alternative. The alternative to bank deposits is something which is outside a bank. So that means the money comes out of the bank into the investment world. Moment it comes into the investment world, you know that the asset prices are going to go up. So always look and track where interest rates are headed. If interest rates are on a downward decline, definitely know that equity markets will be on an incline very, very soon. All right. So these are the golden things that one needs to keep in mind as you are looking at investments and so on. Let me now pull up some kind of polling questions once again, please. Can we have the polling question number 6, please, on the screen? Number 6. Asset type class typically has higher volatility. Is it equity? Is it debt? Or both are similar? Cannot be determined. Quickly, which asset type has typically higher volatility? Come on. Last 20 seconds. I think it's a very simple question. Which asset class typically has higher volatility? Last 10 seconds. Okay. Can we have the results published, please? All right. Great. 89% of you have got the right answer. Super. So equity definitely delivers a higher return in India, but it has got a significantly higher volatility. Remember. And the volatility from the equity market is almost 50 or 60% higher than the return. So the return 10% hai, volatility 16%. Okay, remember, it is not always an easy choice to invest into equity. Equity investments comes with additional volatility. Okay. Can we have the polling question number 3? Back to back, please. Polling question number 3. Okay. So what is tax loss harvesting aiming at? Okay. So are we looking to increase income, reduce taxable income, increase tax liability, or reduce interest? Reducing investments. What is it aiming at? On last 20 seconds, all of you. Seconds. I think all of you are getting the right answers. It is very, very heartening to see that all of you are clicking. But may I request all of you to respond, please, each one of you. It could refresh the mind. It could make your belief and learning stronger once you click the button. Can we have the results published, please? Can we publish the results, please? All right, super. So reducing tax liability. Okay, super. Can we have one more? You as an investor, can we have the polling question number 8 on the screen, please? You as an investor, polling question number 8 on the screen, please. Okay. Why is continuous improvement necessary? Why is continuous improvement necessary as an investor? To keep up with market changes, to reduce taxes, to avoid all risk, or all of the above? Think through deeply before responding. Okay? Think through deeply before responding. I expect you guys to click the right answer, but as of it doesn't seem so. As an investor, there is a need to keep up with something. There has to be some continuous improvement. Okay. Last 10 seconds. All right, can we have the results published, please? Unfortunately, 7, all of the above is not the right answer. You as an investor, you cannot continuously work on reducing taxes. You as an investor, it is not possible to avoid all risks all the time. It is not possible. So it is definitely not all of the above. It is to keep up with market changes. We as investors definitely have to keep tracking the market so as to understand in which direction the market is headed. All right, super. So I'm going to take a pause right now, and I'm going to open it up for a little bit about Q&A to understand the kind of questions that are there. And at the same time, I would also love to discuss few important program choices, educational choices that you as a person can make in life. Okay. So let me first quickly go through some Q&A. Is there any question for us already on the screen, please?
Everybody, you can type in your questions in the chat section. We will pick up, questions that around 5 to 6 questions. Are you okay with that? We have 15 minutes only. Let's pick 5 questions. Are you okay with that, Sujay?
Absolutely.
Okay.
So maybe I'll take 1 or 2 questions now, move on with the presentation and come back to the rest.
Sure.
So is someone going to collect this question for me, or do I need to go through them?
Oh, hi. So we have.
Okay, so there is a question. Is anybody doing that for me, or should I pick it up randomly?
Ania, you can do it. In case if you have identified the question, you can proceed and ask.
Ihina, are you doing it for us, or should I pick it up randomly? Can we have a response to this quickly?
Yes, I can do it for you. So we have a question that what is your take on mutual funds? Which is better for long-term horizon, index funds or ELSS funds?
Okay, wonderful question. Thank you, Nandini, for that. So mutual funds is definitely a great option for investors. Why is it a great option? Because investment is a complicated subject. We as investors, it's sometimes not possible to keep a track about how the markets are behaving continuously. But the people who manage the money at a mutual fund, they are professionals. They are paid to do this task. So we as retail investors, if we call ourselves retail investors who are busy with our own corporate job, definitely would like to have somebody who will do this task for ourselves. Like we definitely need a carpenter to construct our sofas and beds. We need a fund manager to manage our money. Okay, so mutual fund definitely is a great choice for anybody who's looking to stay invested in the market. That is one. Secondly, the question was whether ELSS, right? What was the differentiation? ELSS, and what was the second one? Nandini?
Index funds.
Index fund. So ELSS is equity linked savings scheme. So it's a great tax saving option. Okay. So if you invest, so I think both of them are very compelling investment choices. You cannot select one over the other. Index fund is a great way of getting invested in the market where you're not paying too much or too high an expense to get invested. So that the cost that a fund manager charges when you invest money in the market through them is actually a cost, right? You have to pay. It is like a fee. When you go to a doctor, you have to pay a fee. Similarly, when you invest through a mutual fund, you have to pay a fee. So the cost or the fees for investing in the market through index fund is abnormally low. Okay, so that is a great way of saving outflows. You're plugging your outflows. ELSS is a great tax saving product. So these are two different. So both of them are great investment choices. I'll take the next question, Nandini.
Yeah, moving on to another question. It is about tax loss harvesting, and is it not going to postpone the tax implication?
Sorry?
It is about tax loss harvesting, and isn't tax loss harvesting going to postpone the tax implication?
Absolutely. So no, it doesn't postpone the tax implication. Oh, that's the beauty of it. It's a very good question. Suppose this year you have made a profit of 100 rupees, okay, and if you do not do any tax loss harvesting, you will end up paying tax on 100 rupees. However, if you book a loss of 100 rupees, you definitely neutralize that position and you don't pay any tax this year and any even in the future years. So it is nullified forever. It is not postponed into the future. Okay. All right. So is there one more question or should I move ahead with the presentation?
I guess you can move ahead with the presentation.
All right. Super. Meenakshi, can we have the next slide, please? I think we wanted to showcase 2-3 things. So one great way to get invested in the market is equity investing. So primarily, there are 2 ways to get invested in the market. Okay? Equities and debt. Okay? Fixed income and equity. Equity investment is a great way to stay invested in the market. And why is it a great way? Because debt investments is naturally happening because you have your bank account. You already have your bank account. So debt investments are already there. So that interest income is anyway coming to you. You can convert that bank investment to some kind of bond investment or a debt mutual fund. You can definitely do that. But that portion is more or less already there. So when you start with investments, you are only talking about to start with equity investments. So there is this equity investment and there is ways of doing equity investment. So there are ways to do some analysis. So fundamental analysis, technical analysis. So it's a very interesting subject. And if somebody is looking to build themselves in the field of equities or technical analysis, learning how to work around derivatives, because once you build your position, you should know how to neutralize your position as well. So once you build a position, that means risk level goes up, then there should be a way to neutralize that position that you do through derivatives. So equity investing, technical analysis, derivatives is a great product for somebody who's looking to build their acumen around equity investing. Let's understand the whys. Why should somebody do it? So firstly, to build your knowledge. Second, to make informed decisions. So while you're making your decision, you make an informed decision for your own financial growth. For your own financial growth, because it's a great asset class. There is no other asset class in India which has come close to equity. People who have stayed invested in equity for long periods have definitely created humongous amount of wealth. It has delivered higher return than gold. It has delivered higher return than silver. It has delivered higher return than real estate. It has delivered higher return than commodities, currency, everything else. So there is nothing which has come close to equity in India. And finally, there are beautiful ways of managing the risk also. So whatever you do, whether you buy a house, whether you buy a car, whether you get invested into commodities, there will be risk. But in equity investing, there are great risk management products which are available. Okay, so this is one product that you can definitely think about for yourself. Can we have the next slide, please? And independence. Okay, independence, obviously. So once you're in control of your finances, you definitely have great independence. Meenakshi, let's move ahead. There is a program which is primarily for somebody who doesn't have too much of time. They want to do something on their self-pace. So you do not want to regularly come to an online classroom, but you want to do some online programs, but you want to do it at your own self-pace. So this is a great program for somebody who wants flexibility in managing their time and managing and building some kind of knowledge for themselves. Okay, let's look at the whys. Whys. Okay, Meenakshi, it's a flexible learning. It is for somebody who wants to manage their time a little better, wants to go up in financial literacy, build a little bit about wealth. It's extremely cost effective. It's a very, very cost effective program. And finally, accessibility. You can do this program for anywhere in the country, on your iPad, on your mobile, on your laptop, everywhere. And obviously, it helps in personal empowerment. And finally, let's look at the third brilliant product for Sodexo. Junior money managers. This is for the young citizens of the country. Anybody within the age of 10 to 16 years. Financial literacy is extremely poor in our country. Financial literacy is extremely poor in our country. There are youngsters for whom their parents are earning money and so on, but one needs to understand the discipline around money. The sooner we plant it in their mind, the better it is for the family and for the society. So this is a brilliant 1-month program for junior money managers for all the young students out there. Okay. Let's look at the whys. Early financial literacy. Obviously, it's a brilliant practical life skill. So it's a life skill because whatever they do in their career later on, whether they grow up to become an engineer, doctor, computer science, whatever, armed forces, wherever, everybody would be earning money. So it is a life skill for somebody, financial literacy. The way you need to know how to drive, you should also know how to manage your money better. And this program is a lovely, engaging, and fun-filled program. Okay? And you prepare yourself for that. Great. So can we have the next question, please, Nandini? Nandini? Nandini, we can hear you.
Inia is helping you out with the questions. Finia is
Ihina, can we have the question, please? I don't hear anybody.
yeah. I'll just check in case Inia is able to hear us. Yeah, she's here.
Hello.
Yeah,
Can you repeat the question, please? Otherwise, I'll move on.
Somebody has asked, does it make sense to have multiple mutual funds, that is hybrid or equity funds?
Oh, hybrid or equity fund. Okay, brilliant. Okay, so this actually is a great question. Okay, so multiple mutual funds is definitely a good choice because when you are investing in the equity market, you are taking a bet on one mutual fund. So instead of taking a bet on one mutual fund, it is always better to diversify. So multiple investments into multiple products is definitely a great choice. Definitely a great choice. Next question, please. Question, please.
Yes. Do direct or regular mutual fund returns vary significantly over the long term since I invest through financial brokers due to less knowledge of the market?
So actually, it makes a significant difference. I'll give you a sense. Like direct mutual funds, on an average, have got an expense ratio of 50 basis points, and regular products have got a difference of around 1.5%. So that additional 1% that you pay to get the advice of a financial broker really adds up to a huge amount of cost over a period of 10, 15, 20, 30, 40 years. So it could be like, suppose in a direct plan, if you are generating 100 rupees final value, the regular plan investors would generate somewhere around 20% lower, around 20%, 30%. So somebody who's reaching 100, the other guy could reach 70. So that is the reason of self-empowerment, of knowing something on your own, so that you can make those choices on your own as well. Okay, super. So I'll just go ahead and tell you what is the offer. Meenakshi, can we have the next slide?
So actually, just stopping you here, somebody's actually asked about the Junior Money Managers program. So if you can talk a little bit more about with the pricing as they want to enroll in it.
So Junior Money Managers is a program for youngsters for the age group of 10 to 16 who are school goers. And this is an early on program for somebody. It's a 1-month duration program delivered completely online by people who are from the industry. It is a 100% activity-based program where they play games. Like there will be games like a stock market simulation. There will be games like a Shark Tank Junior. There would be games around bank charades and so on. So every financial concept is learn through an activity. Okay, so it's actually a super hit program for youngsters. It's every concept is learned through an activity. I will go through the next slides. I think those details would come up. Meenakshi, if you have heard me, okay. So the price of these programs are on the screen. Okay. However, these are not the prices for all the clients of Sodexo. So there is a special price for the people of Sodexo. Can we move ahead, please, Meenakshi? So the special fees for Sodexo is that junior money managers is for today at 6,000 rupees. Okay. Junior is at 6,000 rupees. Certified program is 12,250, and equity investing is brought down by 50% to 10,000. Can we have the entire screen, please, Meenakshi? Okay, great. So junior money managers is a 1-month program. Equity investing is a 2 months, and the certified program is a 40-hour session, which is completely hybrid. So there are 40 hours of self-study, and then there is live programs. Okay, super. Can we have the next question come up, please?
Just
Who is the
a
first?
second. Someone's asked, is there any tool available which will analyze our portfolio and suggest recommendation for tax loss harvesting?
Absolutely. So this is a very simple product. So you don't need too much of software to even assess that. So any tool that you use, I think whether you're using any broker software or any bank software or any direct investment software, so you would always get to know what is the capital gains, right? So you don't need any special tool for that. So you have to just check what is the capital gains on your portfolio. Okay? You have to just pull out the capital gain statement, and on the capital gain statement, you will see positions which are positive, and then there are positions which are negative, generating negative. You have to just nullify those positions. That's all. You don't need any special tool. So any software that you're using, or you can even do it on Excel. So आपका investment price and your current valuation price, which difference में अगर positive है तो capital gain है, अगर negative है तो capital loss है. When you are booking some gains, you have to book it against. Only thing you have to remember, the gains of equity has to be set up against the losses of equity. Gains of debt has to be set up against the losses of debt. Next question, please. I think we'll have time for one last question.
Is it possible to get a bank loan to purchase open land or commercial property in order to save long-term capital gain?
Yes, so this is a possibility. There are few banks in India who definitely give out loans for buying commercial property and open land as well. Earlier, open land loan for an open land was not easy to come by. There used to be only 1 or 2 banks in India, but these days there are quite a handful number of banks. Loan against commercial property is quite easy. I think most of the banks actually do that. And you also get an overdraft facility, you get loan against your property, lab facilities, and so on. So that's quite easy. Super. I think the clock has struck 4. Okay. And I think we have to now conclude today's session. I would hand it over to the organizers of Sodexo, please.
Thank you so much, Sujoy. I'm really glad that this session went well. There were a few glitches. We're really sorry about that. That we had an overwhelming response. We had over 2,000 people joining in. That's a great thing for you, for us as well at Sodexo. And thank you so much for everyone who joined us today. We hope that a few of your questions, your ideas about tax has changed thanks to Sujoy, and we hope that you join us even next month for another session, for another. It could be another completely different topic. And thank you so much to the Ovawa team to help us organize this today. And we're really, really glad that you were there today to help us with this session.
So before you guys go away, so we have posted the feedback form in the chat box. So may we request all of you to share your feedback with us. It would be wonderful to get to know what you think about us. Please don't forget to click on the feedback form.
Yes, thank you. Thank you so much. Thank you everyone for joining. And do visit Ovawa's website. And like they mentioned, they have multiple plans. Do explore. And if you have your Sodexo card with you, you can use your Sodexo card. If you have your wallet, learning and development wallet, you can use the card and at the same time save on the offer that OVA has with Sodexo. Thank you so much, everybody. Thank you, Sujoy again. And
Thank you very
see you.
much.
Thank you.
Thank you. Thank you. Bye.